A week ago today, Greece's newly elected Syriza party entered into an agreement giving it a 4-month extension on a bailout deal in a move that is widely being cast as the party's first major defeat. Coming to power with much pomp and celebration, the government of Alexis Tsipras offered promises to end austerity in a country that has seen the worst downturn in Western Europe since the 1930s. But Europe's financial elite would have none of it, and the Eurozone finance minister stood their ground last week in refusing to budge on most of Syriza's demands. As of now, the only power that the Greek government has over its economy is the power to choose which cuts to make and where in order to satisfy structural adjustment requirements of its debt obligations. Syriza has taken a major beating in both the major media and many parts of the left blogosphere. The question is, what choice did they have? My guest is Nantina Vgontzas. She is a Greek-American PhD student in sociology at New York University, focusing on political economy and social movements. She's active in the labor movement and currently a member of the UAW Graduate Student Organizing Committee, and she's lived and worked in Athens for a year following the elections. Welcome to Uprising, Nantina.
Thanks for having me, Sonali.
Thanks for joining us, and welcome back. I should say we had you on right after the election. So how do you explain what happened last week? What leverage did Tsipras and his finance minister, Yanis Varoufakis, have last week going into these negotiations, and how did they lose that leverage?
Yeah, so we should start, with Monday, when ostensibly they were about to arrive at an agreement with a document that Pierre Moscovici, the the European Commissioner for Economic Affairs, had presented to Varoufakis and the rest of the Greek negotiating team. That seemed pretty amenable to what the Greek government was expecting. But in the last minute of that day, Jerome Dijsselbloem was the president of the Eurogroup, which is the body of Eurozone finance ministers, changed that document, and the Greek government rejected that. So then, moving into the week, they reached basically a kind of intransigence on the creditors' part, which amounted to increasing pressures, both in terms of financial speculation, the stock markets are starting to vacillate, but also in terms of withdrawal from banks. This was a really big issue that Syriza had to deal with even upon entering power. 20 billion euros have been withdrawn from Greek banks since December, and on Friday alone, 1 billion euros were withdrawn. So, the Greek government was really facing an issue of a possible bank run, of banks going essentially bankrupt, and they had to make a move as to whether to agree to the deal which you accurately laid out as being a retreat on many of its electoral promises, or of taking more drastic measures that would have given it, more time to, stick to its own guns. And those measures would have included imposing capital controls, even nationalizing the banks, and then, even more drastically considering default and exiting from the currency union. And it really seems that that was not in their plan. Varoufakis had said to the media and, of course, to the negotiators going into this that, we're going to be able to convince you that this is something that's not just good for Greece, but for Europe, because we want to raise growth levels throughout the currency union.